country background. With a population of 235 million on 13,000 islands spread over an area of 3,000 times 13,000 million on 13,000 islands spread over an area of 3,000 times 1,250 miles, the Republic of Indonesia was the world's fourth most populous nation. Its population consisted of around 300 distinct native ethnicities and 5 major religions. Indonesia was rich in natural resources and had a climate conducive to many forms of agriculture, from forestry, mining, and rubber. Currently, Indonesia was divided into 33 provinces and a special capital region. Indonesia was also an active member of Association of Southeast Asian Nations, or ASEAN, the Organization of Southeast Asian Countries, and belonged to the Asia-Pacific Economic Cooperation, or APEC, which covered the entire Pacific area. And to a lesser extent, the companies owned by ethnic Chinese. He played a dominant role with few checks and balance. The government pursued policies to support ingenious businesses through the implementation of Benteng Regulation in 1995. Sukarno won Indonesia's first general election, and during his reign, Sukarno introduced Indonesian-style socialism in guided economic. State-owned companies and trading houses were created, which received preferential financing and monopoly rights for the import of essential commodities. In 1965, Sukarno gave his power to Suharto. Sukarno's policies led to massive budget deficits and soaring inflation, which exceed 600% annually and collapsed. The economy stagnated and was close to collapse by the mid-1960s amid social disorder. In 1960, Indonesia was among the poorest countries in the world. Most of the population lived in rural regions, and agriculture accounted for more than 50% of GDP. The country had become, in the words of one observer, a basket case. Inheriting a bankrupt economy, Suharto's top priority was a quick recovery. He moved to regain macroeconomic stability and managed to control inflation. Conditions imposed by the International Monetary Fund, or IMF, and the World Bank played a role in setting macroeconomic policies. An influential group of economics advisors from the University of Indonesia, called the Berkeley Mafia, also exercised an influential voice in favor of stable macroeconomic policies. The Foreign Investment Law in 1967 and the Domestic Investment Law in 1968 reopened the door to investment, making it easier to secure government approvals. The Intergovernmental Group on Indonesia, or IGGI, an international group of countries and international financial institutions lending to Indonesia, was established in 1967 by the Netherlands to coordinate multilateral aid to the country. The government also started to rehabilitate the dilapidated physical infrastructure and began investing in rural development. However, the oil booms in the 1970s led to a gradual reorientation of economic policy toward an ambitious state-led industrialization program of establishing large-scale, capital-intensive industries. This effort gained a high-tech bent when Dr. B.J. Habibie was appointed Minister of State of Research and Technology. A group of large domestic business groups emerged under the patronage of senior government and military officials. While there was a general trend toward liberalizations, some economists complained that progress was slow and not comprehensive enough. There was also concern about exemption that created advantageous market position for companies related to Suharto's family and his associates. Economic growth was restored, and the share of oil and gas export to total export declined from over 70% in 1983 to 40% in 1998. Imports grew strongly, however, and external debt rose to $57 billion. During the Suharto era, the World Bank's total lending to Indonesia had been $25 billion, and World Bank staff viewed the country's progress from 50% to 300% of India's GDP per capita over the last 3 decades as a success story. In July 1997, the Asian financial crisis began in Thailand, as the Central Bank of Thailand was forced by market pressure to float the Thai currency. The rupiah and Jakarta Stock Exchange touched historic lows in September. Moody's downgraded Indonesia's long-term debt to junk bond status. Real GDP contracted by more than 13%, more than in any other Asian country. As inflation reached 70%, steep hikes in food prices led to riots throughout the countries, and more than 500 people died in Jakarta alone. By January 1998, the rupiah was in free fall, reaching rupiahs 17,700 per $1, a devaluation of 700% in just 6 months. Suharto was succeeded by his vice president, B.J. Habibie. Habibie sought to reduce the role of the military in Indonesian politics and promised major political and economic reforms. By mid-1999, macroeconomic stability improved, with the rupiah appreciating to 7,000 per $, from its lows of 12,000 in mid-1998. Inflation dropped into single digits and interest rates fell. Large Indonesian business groups worked to reduce heavy debt burdens and restructure through divestment and increasing focus. Habibie identified the decentralization of public decision-making as a key priority. Indonesia in transition. During this time, several events took place that gave another test to Indonesia as a country. In October 2002, Bali was bombed and claimed more than 200 casualties. Indonesia became unseen as unsafe place for businesses and tourism. Indonesia also finally graduated from IMF support, making it the last to do so among Asian countries. A white paper economic policy package pre- and post-IMF in September 2003 outlined over 100 specific commitments by government to maintain macroeconomic stability, restructure the financial sector, and increase investment, export, and employment. President Megawati declared 2003 to be the year of investment. The Megawati administration implemented the tariff reduction that had been agreed to under the Asian Free Trade Agreement in 1992, but repeatedly expressed concern about the fast pace of liberalization and implemented emergency exit clauses to retain protection for some sectors. GDP growth increased from 0.3% in 1999 to 5% in 2004. Prosperity growth turned positive, reaching 3%. Unemployment fell, and the poverty rate dropped from 19.1% in 2000 to 16.6% in 2004. External public debt declined from about 103% of GDP in 1999 to 59.8% in 2004. Dr. Susilo Bambang Yudhoyono from the small secular Nationalist Democratic Party won a 61% victory over President Megawati in the final round in voting in September 2004 and became Indonesia's first directly elected president. He announced a 100-day plan of economic reforms, including more active engagement in Asia and with the WTO. Regional government had been unable to implement needed infrastructure investment given limited capacity, which had left government budget with significant surpluses. In 2005, the government had taken the final step to remove fuel subsidies. Historically, a huge expensive part of Indonesia's social transfer system, the government had launched a compensation program for the poor during the first round of price increases, about 29%, but their design and implementation had been poor. Indonesia's economic in 2006. In 2004, Indonesia has $254 billion in GDP measured at current market price. This made Indonesia the biggest economy in Southeast Asia. Indonesia was only surpassed by China and India, However, on the per capita basis, Indonesia was only slightly better than India and Vietnam, leaving other countries in the fourth position. Unemployment, at 10%, had been rising over the last few years as 2 until 2.5 million Indonesians were entering the labor market every year, significantly above the number of the new job openings. Productivity in Indonesia was about 60% of the Thai level and 33% of the Malaysian level. India, whose productivity level had been far below Indonesia's, had caught up. Domestic investment rates remained low, and there had been a net outflow of foreign capital since 1997. Indonesia's overall market share in global export had been roughly stable since 1997. Indonesian macroeconomic conditions were stable or improving. The government budget was balanced, and the public debt had fallen steadily from about 90% in 2000 to about 50% of GDP, comparable to other countries in the regions. Indonesia and foreign investment.
Now,
Okay, well, first of all, I'm not a business person, but I have been in Indonesia for the last 7 years, since 2005. So yeah, I'm not a business-minded person, but being here, I've seen Bandung in particular really develop since I've been here. There seems to be a very large middle class in Indonesia, which seems to be growing all the time, and Bandung is a place of tourism with restaurants and cafes. I've seen not only the businesses change, but also the infrastructure of Bandung change. So it looks to me, if I was an investor or someone who was looking at investing in business, it would look like quite a prosperous place to do business, in my opinion. Saying that, as a foreigner, it's quite difficult to do business in Indonesia. There are quite a lot of restrictions.
about the rules and
The rules,
the bonds.
can't own property
Okay.
and heavily taxed. So I think some restrictions on foreigners as business people, but again, not from a business.
Indonesia had a long story of foreign direct investment, with Dutch companies having been dominant in most parts of the Indonesian economy until the early decades of the 20th century, especially the extraction of natural resources, utilities, and trade. Many Dutch companies had been awarded dominant market position by the Dutch government and were perceived as instrument of colonial suppression and extortion in the decades up to World War II companies from other Western nations, especially the United Kingdom and the United States, invested in Indonesia. Most of these companies were active in oil and other natural resource-based industries. After independence, the Indonesian government nationalized many foreign companies, especially those from the Netherlands. However, some large United States and United Kingdom companies remain active in the country. In 1950s, Indonesia was among the top 3 Asian locations for US investors, along with India and the Philippines. In the 1970s and 1980s, Japanese, Singaporean, and Taiwanese companies became leading investors in Indonesia, especially in manufacturing. In the late 1980s and early 1990s, Indonesia experienced an investment boom. Successive reform in the 1998s had made the country more attractive to investors, and Korean and Taiwanese companies began relocating their labor-intensive operation to Indonesia as well as other Southeast Asian countries around 1990. During the Asian financial crisis, FDI inflows into Indonesia collapsed, and net inflows were negative for almost years until 2003. A number of Korean and Japanese companies operating in Indonesia relocated to other countries in the region, including Vietnam, citing Indonesia's negative investment climate. While there was improvement in 2004 and 2005, Indonesia continued to lag far behind most of its neighbors in attracting investment. As of 2006, Japanese companies remained the largest group of foreign investors in Indonesia, followed by the companies from Korea and Taiwan. Asian investors, led by Singapore and China, had been the leading investor after the Asian financial crisis, while companies from Europe and North America had lagged. The stock of foreign investment continued to be concentrated in natural resource-based industries, with a third or less in manufacturing. Close to 60% of FDI inflows after the crisis had gone into manufacturing, metal mining, and chemical in particular. Since 2004, services had gained in importance. Foreign investment rules and regulation. Indonesia had a story of fluctuating incentive for foreign investors. The law in 1967 for foreign investment granted investors a tax holiday of up to 5 years from corporate tax and withholding tax of dividends. In 1977, BKPM further specified list of industries that were closed, open for FDI, but with no tax incentive, and open for FDI and qualified for tax incentive. In 1984, all tax incentives were eliminated based on advice from the Harvard Institute for International Development. In 1994, tax incentives started to come back when the government awarded ExxonMobil an attractive division of revenues from a natural gas field in the Natuna Sea. 2 years later, investment incentives were reintroduced more generally. Under the new scheme, an interministerial team had discretion for case-by-case decision. In practice, President Suharto made the decision which often benefited companies related to his family or associates. In 1998, the tax incentives were again eliminated under pressure from the IMF. An amendment to the tax law in 2000, however, offered the new incentive in the form of investment allowance, accelerated depreciation, and longer loss carry-forwards on investment. A 2003 white paper committed the government to introducing a new investment law that would establish BKPM as a one-stop shop for investors. The government announced in 2004 that the role of BKPM was to change from investment approval to investment attraction. 2006 data indicated that infrastructure bottlenecks were an increasing concern for investors, especially for export-oriented companies in areas like electronics. Recommendation. Finally, what should Indonesia do to distinguish itself as a favorite foreign investment destination? Here are several steps that Indonesia needs to undertake to invite more foreign investment. Managing macroeconomic stability. These include the following measures. The need to maintain awareness of the close connection between economics and politics. As the background of Indonesia, that the dynamic of politics and economics are not naturally in harmony. The condition required here is that the political system should provide an environment that enables economic policies. The condition required here is that the political system should provide an environment that enables economic policies process to be professionally managed with the sufficiency from undue political pressure. This then needs a strong economic team, which consists of like-minded professionals who had developed mutual trust and clearly recognized intellectual economic leader. In its process, this team should have a full trust and a backing of the President in implementing the whole sequence of economic policies. In the final reality, it is now becoming the task of the leaders of the country to come to the best workable balance in the need to secure maximum policy effectiveness and the imperative of accommodating political necessities. In that condition, while the economic policies process is capable in delivering the result, then the economic performance will just accompany. Constant vigilance about economic stability and budget through government finance stability. Making fiscal policy as the anchor of economic stability is very crucial, and it can serve the link between political dynamic and economic performance in Indonesia. A credible strategy and focus on institution and governance. This will include strengthening institution and governance, financial sector strategy, domestic competition policy, management of natural resources, and environment protection and strategy on a small-scale enterprises. Improving investment climate. In the longer term, the most important means of attracting investment is to improve the general investment environment. Some points should be dealt to improve investment climate in Indonesia. Developing financial sector. The development of financial system of recipient country is an important precondition for FDI to have positive impact on economic growth. A more developed financial system positively contributes to the process of technology diffusion associated with FDI. Improving regulatory environment and strengthening institutional services. Indonesia needs to continue dismantling its cumbersome regulatory framework in order to reduce the still high facilitation cost and long time process of starting doing businesses associated with setting up a new FDI. Improving absorption capacity. In order to maximize the impact of the presence of FDI to economic growth, the country should have enough absorption room. This will include developing human resource skill. In order to maximize the benefit of the presence of FDI, the host country should also have human capital and technology absorptive capacity. Developing domestic infrastructure for attracting more FDI is a further policy to take in place. It might be case of Indonesia, while many investors are interested to invest based on potential market and available resources. But domestic infrastructure does not meet capacity to do the business. Finally, when the macroeconomic stability had been in place and the condition is able to deliver the result of policies, then economic growth will sustain as more FDI will further inflow.